I want you to take a second and just imagine two different people.
Okay.
So the first is a 15th century Italian spice merchant. He's standing on this wooden dock in Venice, just staring out at the, choppy gray water of the Mediterranean.
Right. In heavy wool, probably sweating.
Exactly, sweating.
Yeah.
And he is mentally calculating the terrifying odds of a wooden ship surviving a massive storm, dodging pirates, and actually making it back from the Levant.
A very stressful job.
Very. Now, the second person is a modern 20-something Silicon Valley venture capitalist. He's in like a fleece vest, sitting in this climate-controlled glass boardroom on Sand Hill Road.
Staring at a pitch deck.
Yeah, a highly polished pitch deck for some new artificial intelligence startup. And on the surface, these two individuals are separated by half a millennium, thousands of miles, and totally different physical realities. But what if I told you that they actually have the exact same job?
It sounds like a massive stretch when you frame it geographically, but structurally, it is entirely accurate. Both of those individuals are utilizing the exact same underlying framework of risk sharing. They are pooling capital to fund highly asymmetric, moonshot ideas.
Things traditional banks won't touch.
Exactly. Traditional conservative lenders, whether that's a Renaissance money lender or a modern commercial bank, they are simply too terrified to touch that kind of binary risk.
And the guy who has mapped exactly how this medieval concept evolved into, a trillion-dollar modern machine is Nishant.
Yes, his work is incredible.
He's a veteran private equity investor who has personally managed and executed transactions exceeding $2 billion across global markets. $2 billion.
It's a staggering number.
So we are anchoring our deep dive today in his professional biography and his frameworks. We'll be diving really heavily into his 2025 book, Capital in the Shadows, along with his work on frontier tech, like the compute shift.
Yeah, and Prabhakar represents a really rare breed in modern capitalism because he operates across three completely different realities simultaneously,
How do you mean?
Well, you have his practitioner side. He's literally in the trenches executing these complex global transactions. Then you have his strategist side where he's trying to identify these 10-year structural shifts in technology.
Right, looking over the horizon.
Exactly. And finally, the author side, where he actually articulates the mechanics of these deals without hiding behind all that dense Wall Street jargon.
Which is exactly what we want to do today. Let's start where he starts, which is the history. Because if you read the financial news today, private equity feels like this modern invention of the 1980s that just, suddenly appeared to buy up retail chains.
And absolutely not. The roots go incredibly deep.
Right. Long before we had modern regulators or central banks, commerce was driven by these early risk-sharing syndicates. We're talking proto-private equity in the 15th to 17th centuries.
Yeah, and to understand why these syndicates formed, you have to look at the sheer scale of the projects. We are talking about transoceanic spice voyages, the establishment of massive mining ventures, early industrial manufacturing.
Things that take a lot of cash.
Immense capital. The money required to just fit out a single galleon for a 2-year voyage was staggering. And the risk was almost incalculable. You had navigation failures, scurvy, shipwrecks.
And literal state-sponsored piracy.
Right. So no single wealthy individual, and certainly no traditional moneylender who just wanted a guaranteed 5% interest rate, could shoulder that kind of binary risk.
It was either you make a fortune or your ship is literally at the bottom of the ocean.
Exactly. So ultra-wealthy banking families in Europe, like the Medicis in Italy or the Fuggers in Germany, they began to syndicate. They pooled their capital together to back expert navigators.
And this perfectly mirrors the power law distribution of modern startup investing. Think about the math here. You are a Venetian merchant, and you fund 10 wooden ships to sail to the other side of the known world.
The odds are against you.
Statistically, that 9 of those ships are going to sink, get captured, or the captain might just run off with the gold. It's a total loss on 9 of them.
But that 10th ship...
But the one ship that does return, with its hull packed to the brim with nutmeg and silk and black pepper, it generates such an astronomical profit that it pays for all 9 sunken ships and still makes you wildly rich.
Which is exactly what venture capitalists do today.
Yeah. You fund 10 startups, 9 go completely bankrupt, but the one that becomes the next Google pays for the whole portfolio.
The payoff structure is identical. It's highly nonlinear. But, there was a ceiling to how far that family syndicate model could scale.
Because there's only so many rich families.
Right. As global trade expanded in the 17th century, the sheer volume of capital needed required a more institutionalized structure. You couldn't just rely on, like, five rich families knowing each other in a courtyard.
So what changed?
This triggered a pivotal moment in financial history. It was the creation of the joint stock company, specifically the Dutch East India Company, or the VOC, founded in 1602.
Okay, so suddenly you didn't have to be a Medici to invest. If you were just, say, a moderately successful baker in Amsterdam, you could walk in and buy a fractional share of this massive enterprise.
Yes, and by doing that, the VOC institutionalized two essential principles of private equity that still dominate the industry right now.
Which are?
First, it completely separated ownership from management. Before this, if you owned a business, you ran the business.
Right, the owner was the guy at the counter.
Exactly. But the VOC created a class of passive investors who just provided the capital, and a separate class of professional managers, the directors and ship captains, who actually ran the daily operations.
That's huge. And the second principle.
Second, it pooled massive permanent capital bases for long-term ventures. The VOC wasn't just a trading firm executing single voyages anymore. I mean, they managed overseas territories, built shipyards, operated a naval fleet.
It was basically a state-backed corporation.
It generated extraordinary returns for its investors over decades. It was the first true institutional private market.
So if the VOC proved that you could pool capital for long-term overseas trade, the Industrial Revolution proved you could use it to build physical infrastructure.
Yes, a massive shift in capital deployment.
We jumped to the 18th and 19th centuries, and we aren't just building ships anymore. We were building mechanized textile mills, massive steel plants, and these incredibly expensive railroad networks across entire continents.
And railroads are the perfect example of why the financial system had to evolve yet again. Because building a transcontinental railroad is phenomenally capital intensive.
You have to lay thousands of miles of steel before you sell a single ticket.
Exactly. Local banks just couldn't handle that. And more importantly, the early U.S. railroad industry was an absolute chaotic mess.
Like the Wild West of finance.
Truly, you had severe overbuilding, chaotic mismanagement, intense price wars, and completely different incompatible track gauges. The industry was structurally in financial distress.
Which brings us to J.P. Morgan in the late 19th century. He steps into this chaos, and from what I understand from the book, he essentially conducts the very first leveraged buyouts, even though they didn't call it that yet.
Morganizing is what they called it.
Morganizing, right?
He didn't just syndicate a loan and walk away hoping to get paid back. He recognized that the underlying assets, the physical rail lines, were incredibly valuable, but the management structures were toxic.
So what did he do?
He stepped in, took active control of these distressed railroads, and forced them into a room.
Wait, he actually took control. I always pictured J.P. Morgan just sitting in his mahogany library underwriting bonds. Like, how active was this ownership?
Oh, it was deeply active. He would use his financial leverage to impose strict governance reforms. He literally fired incompetent executives and installed competent management teams that answered directly to him.
Wow.
He forced fragmented, competing railroad networks to consolidate so they weren't bleeding each other dry in these brutal price wars, and he fundamentally restructured their massive debt.
So he's not just a banker, he's an operator.
He proved a vital thesis. If you combine rigorous financial discipline with harsh operational restructuring, you can salvage a dying enterprise and generate massive returns.
So Morgan proves the buyout model for heavy industry. But if he proved it in the 1890s, why did it take until, the mid-20th century for private equity to actually become a recognizable industry?
Because you needed a massive structural shock to force institutional capital-like university endowments and insurance companies to actually take risks on unproven ideas.
And that shock was World War II.
Exactly. After the war, Europe's industrial base is devastated, global trade is entirely disrupted, but at the same time, you have this explosion of wartime technological innovation.
Right, things like radar, computing, aerospace.
Yeah, and you have these brilliant entrepreneurs trying to commercialize it.
But I'm guessing the traditional banks in, say, 1946 were absolutely terrified of funding something like early computing.
Oh, they wouldn't touch it with a 10-foot pole. A commercial bank wants collateral. They want a physical factory they can repossess if you default on the loan.
You can't repossess an algorithm.
Or a prototype circuit board. So this massive mismatch between the capital needs of post-war entrepreneurs and the risk tolerance of traditional banks created a huge vacuum.
Which led to ARDC.
Right. In 1946, a group led by the president of MIT and a prominent financier founded the American Research and Development Corporation, or ARDC.
And they are widely considered the first modern venture capital fund, right?
Yes, their mandate was radical at the time. They convinced institutional allocators to give them money specifically to deploy into high-risk, high-growth, entirely unproven technology companies.
And their entire thesis was vindicated by one specific investment. They made a $70,000 bet on a startup that had zero track record called Digital Equipment Corporation, or DEC.
A legendary bet.
And that $70,000 bet, when DEC eventually went public years later, ballooned to a value exceeding $350 million.
Which sent an absolute shockwave through the financial world. I mean, that single transaction proved to institutional investors that patient, professionalized, high-risk private investing could crush the relatively safe, predictable returns you'd get in the public stock market.
So the West Coast of the U.S. takes that ARDC model and runs with it, birthing the Silicon Valley venture capital ecosystem we know today. But on the East Coast, in the 1980s, the financial industry takes the old J.P. Morgan buyout concept and just pumps it full of steroids.
The LBO boom.
Yes, the birth of the modern LBO, the leveraged buyout. We are talking the era of corporate raiders, the Gordon Gekko stereotypes, hostile takeovers, and firms like KKR.
Yeah, the 1980s LBO boom was driven by a very specific, almost aggressive philosophy regarding public markets.
What was the mindset?
The belief was that many large, publicly traded American corporations had become deeply bloated. Their management teams were totally insulated. They had massive corporate headquarters, private jets,
Just burning cash.
Right, and they were sitting on these diverse portfolios of totally unrelated businesses that were wildly inefficient.
And the crown jewel of this era, the deal that absolutely defines it, was the buyout of RGR Nabisco in 1989. For anyone listening who hasn't read Barbarians at the Gate, this is a $31 billion deal. In 1989, the scale is just absurd.
The RJR Nabisco deal is the ultimate case study of this era's mechanics. The private equity firms, the corporate raiders, would identify a bloated company. They would acquire it by taking it private, meaning buying all its shares off the stock market.
But they didn't just write a $31 billion check from their checking account.
No, they didn't use their own cash to buy it. They used a massive amount of debt. They would borrow billions of dollars, often using high-yield junk bonds, to finance the purchase. That's the leveraged part of the leveraged buyout.
And the rationale wasn't just that they didn't have the cash. The debt itself was a weapon.
Correct. Precisely. Well, it was a weapon and a straitjacket. The logic was that the sheer crushing burden of that debt would force the company's management to instantly sober up.
Because the interest payments are due every month.
Right. When you suddenly owe billions in interest payments, you can no longer afford the corporate jets. You have to ruthlessly cut wasteful spending. You have to sell off non-core divisions just to make the monthly debt service.
The leverage forces efficiency.
Exactly. And because the private equity firm put down very little of their own actual equity to buy the company, if the company survived and eventually paid down that debt, the returns on the PE firm's small slice of equity were astronomical.
But this era was fundamentally about financial engineering. It was about shuffling the capital structure, issuing junk bonds, stripping out costs, and riding the wave. You're not necessarily building a better underlying product, you're just optimizing the balance sheet.
It was highly effective for a decade because there was so much low-hanging fruit, the corporate bloat was real, but pure financial engineering has a strict mathematical limit.
Right. You run out of things to cut.
Exactly. You can only fire so many middle managers, you can only sell off so many subsidiaries, and you can only load a balance sheet with so much debt before the underlying company simply snaps under the pressure and goes bankrupt.
It's not a sustainable engine for growth.
No. As the industry matured into the 1990s and 2000s, and as more PE firms entered the space competing for the same deals, the low-hanging fruit vanished. Simply buying a company and loading it with debt was no longer a viable strategy for outsized returns.
The trick stopped working. If you want to survive today, you can't just be a spreadsheet wizard who knows how to issue junk bonds. You actually have to know how to build a fundamentally better business.
Which is a totally different skill set.
And that evolution, that shift from financial engineering to operational mastery, is where Nishant Prabhakar's work really shines.
But to truly appreciate how radical Prabhakar's shift toward operations is, we first have to demystify the core mechanical engine of how private equity actually values and buys a company.
Yeah, because if a listener picks up the Wall Street Journal right now, they're going to hit an absolute wall of intimidating acronyms.
It's designed to sound complicated, but the math is actually quite intuitive.
Let's break down that wall then. We need to decode the machine. If I'm reading about a buyout, the first two terms I'm going to see constantly are enterprise value and equity value. Why do PE firms use two different numbers to describe what a company is worth?
Because they measure two completely different things. When a private equity professional evaluates a target company, they don't look at its stock price or its market capitalization. They calculate the enterprise value, or EV.
Okay, EV, what is that?
Enterprise value is the theoretical takeover price of the entire business, regardless of how it is currently financed. It represents the value of the core operating engine to all its capital providers, both the banks holding its debt and the shareholders holding its equity.
Okay, and equity value.
Equity value, on the other hand, is simply what is left over for the shareholders after you deduct all the company's outstanding debt and add back any cash sitting in its bank accounts.
Let's ground this with an analogy that everyone deals with, like real estate. Let's say I'm buying a house, and the seller and I agree the property is worth $1 million. That $1 million is the enterprise value, right?
Yeah. Exactly. It is the total value of the physical house and the land.
But I don't just hand the seller a briefcase with $1 million. I find out the seller currently has a $600,000 mortgage on the property. So to clear the transaction, I take on or pay off that $600,000 mortgage, and I write the seller a check for the remaining $400,000.
And that check is your equity.
Right. That $400,000 check is the equity value. It's the value of their actual ownership stake. But let's add a wrinkle, just to match the corporate math. Say this seller accidentally left $50,000 in cold, hard cash sitting in a shoebox in the master bedroom closet, and the contract says I get to keep anything left in the house.
A lucky find.
Very lucky. I effectively paid $400,000 in equity, but I instantly recouped $50,000 in cash, lowering my true out-of-pocket cost.
That is the exact mathematical operation a PE associate performs. Enterprise value is the whole house. Equity value is the house minus the mortgage plus the cash in the shoebox.
Okay, that makes sense. But why the focus on enterprise value?
The reason PE firms focus on the $1 million enterprise value when evaluating a deal is because they intend to completely rip out the existing mortgage anyway. They are going to restructure the capital with their own banks. So they need to know what the bare underlying economic engine is worth.
Which naturally leads to the next question. How do you measure the horsepower of that underlying engine? How do you know the house's foundation isn't rotting?
That brings us to the most famous or maybe infamous acronym in finance.
EBITDA. Earnings before interest, taxes, depreciation, and amortization. I have friends who run small businesses who complain about their net profit, but a PE firm doesn't care about net profit.
Right.
Why the obsession with EBITDA?
Because net profit, the number at the very bottom of an income statement, is deeply distorted by a company's past decisions and its geographic location. It doesn't tell you how well the company operates today.
Give me an example.
Imagine two identical widget factories. They produce the exact same number of widgets with the exact same number of employees and the exact same efficiency. Their core operations are clones. But Factory A is located in a high-tax state and took out a massive loan 10 years ago with a terrible interest rate. Factory B is in a tax haven and has zero debt.
Factory B is going to show a massively higher net profit.
Exactly. But if you are a private equity buyer, you don't care about Factory A's old, terrible loan because you are going to pay it off and refinance it anyway, and you might restructure their corporate taxes, so net profit misleads you. By stripping away the interest and taxes, you remove the capital structure and the geography.
Okay, that covers the I and the T, but what about the D and the A? Depreciation and amortization? Those sound like accounting dark arts.
They are. They are non-cash accounting charges that further distort reality. Let's stick with the factory. Let's say Factory A bought a massive $10 million piece of robotics equipment 3 years ago.
Okay.
According to tax law, they have to depreciate that equipment on their books, meaning they subtract $1 million from their profits every year for 10 years to account for the machine aging.
Ah, I see.
But they aren't actually writing a $1 million check to anyone this year. That cash already left the building 3 years ago. Amortization is the exact same concept, just applied to intangible things like software patents or brand rights.
So by adding back the interest, the taxes, the depreciation, and the amortization to the net income, you get EBITDA. It strips away the past, it strips away the accountants, and it leaves you with the raw, recurring, pure cash-generating power of the day-to-day business.
It is the heartbeat of the company. Once a PE firm knows the EBITDA, they typically value the company as a multiple of that number.
So if a company generates 10 million in EBITDA,
If the heartbeat is strong and predictable, they might pay 10 or 12 times EBITDA to acquire the enterprise value, so 100 or 120 million.
all right, so we know how they value the engine. Now we have to talk about the fuel. We have to talk about leverage. We established earlier that the 1980s LBOs used debt as a weapon. But how does the actual math of an LBO generate those legendary 30% or 40% annualized returns that PE firms brag about?
It relies on a very elegant mathematical amplification. Let's walk through a simplified but highly realistic scenario. Let's say a private equity firm wants to buy a mid-sized logistics company in India. The agreed-upon enterprise value is 1,000 crore.
For our listeners, a crore is 10 million rupees. It's the standard metric in Indian finance, which we're going to explore deeply in a moment. So 1,000 crore valuation.
Right. The private equity firm does not wire 1,000 crore from their own bank account. They use leverage. They go to a syndicate of banks and borrow 600 crore, securing that loan against the assets of the logistics company they are buying.
And the rest.
Then the PE firm writes a check for the remaining 400 crore from their own fund. So on day one, the capital structure is 400 equity, 600 debt.
Okay, I follow. They bought a 1,000 crore house with a 60% mortgage.
Now, the PE firm holds the company for 5 years. Over those 5 years, they improve the operations modestly. The company isn't the next tech unicorn, it's just a solid logistics firm. The total enterprise value grows by just 20% over half a decade, taking the total value from 1,000 crore to 1,200 crore.
A 20% growth over 5 years is incredibly grounded. That's less than 4% a year. You could almost get that by just raising prices with inflation.
Exactly. It's a very conservative operating assumption. But let's look at what happens at the exit. After 5 years, they sell the company for that 1,200 crore.
Okay, let's do the math.
The bank that lent them the 600 crore doesn't get a share of the profits. The debt is fixed. The bank just wants its 600 crore back. So from the 1,200 crore sale price, you pay off the 600 crore debt. What is left for the private equity firm?
You take the 1,200 crore sale minus the 600 crore you owe the bank, which leaves 600 crore in cash. But wait, the PE firm only put in 400 crore originally.
You see the magic. The underlying business only grew by 20%. But because the debt stayed flat, the PE firm's equity grew from 400 crore to 600 crore. That is a 50% absolute gain on their invested capital.
The debt acts like a physical fulcrum. A tiny 20% nudge in the total value creates a massive 50% swing in the equity return.
And I'd take it a step further. In reality, the return is usually much higher because over those 5 years, the logistics company was generating EBIT to cash flow.
Right, they're making money every month.
Exactly. The PE firm uses that cash flow to pay down the principal on the 600 crore loan. So by year 5, maybe they only owe the bank 400 crore. If you sell for 1,200 and only owe 400, your equity is now 800. You've doubled your money on a company that barely grew.
That is why leverage is the defining tool of the industry.
Absolutely.
You're right on the math, but the psychology of that debt is where it gets really intense for the people actually running the company. Having 600 crore in debt hanging over your head changes how a CEO sleeps at night.
It creates a state of perpetual urgency. When your margin for error vanishes because you have a massive interest payment due on the first of every month, corporate vanity projects die instantly.
No more private jets.
No more private jets, and you can't afford to let millions of dollars of inventory sit gathering dust in a warehouse. You can't afford a bloated middle management layer that doesn't directly contribute to revenue. The leverage forces the management team into a hyper-focus on cash generation. It is a brutal but highly effective disciplinarian.
There's one final piece of this machine we need to decode before we move to the modern era. I keep saying the PE firm writes the checks for 400 crore. But that 400 crore isn't usually the personal savings of the guys in the fleece vests on Sand Hill Road.
Not at all.
Where does this ocean of private capital actually originate?
This is perhaps the single most misunderstood dynamic in global finance. The private equity firm entities like Blackstone, KKR, or smaller regional funds, they are merely the general partners. They are the managers.
So who are the owners?
The actual capital comes from the limited partners, or LPs. And the LPs are massive institutional allocators. We are talking about the California Public Employees Retirement System, university endowments like Harvard or Yale, philanthropic foundations, and massive sovereign wealth funds like ADIA from Abu Dhabi or GIC from Singapore.
Let me stop you there. So when a private equity firm executes a hostile takeover of a retail chain or buys out a regional hospital network, The ultimate owners providing the capital are essentially teachers' pension funds, firefighters' retirements, and the national savings of sovereign states.
Yes. The underlying capital of private equity is largely public and institutional money, and this fundamentally dictates how the industry behaves.
Because they have strict requirements.
Think about a pension fund. They have a massive liability matching problem. They know that in 20 years, they have to pay out billions of dollars to retiring teachers. If they just buy safe government bonds yielding 3%, they won't have enough money and the pension system will go bankrupt.
They need higher yields.
They need 8% or 10% annualized returns to survive. So they allocate a portion of their massive portfolios to private equity, demanding that the general partners generate outsized illiquidity premiums.
The LPs are the ultimate boss. If a PE firm takes reckless risks and loses the capital, or if they just play it safe and underperform the stock market, the LPs will simply refuse to invest in their next fund, and the PE firm ceases to exist.
The discipline doesn't come from Wall Street regulators. It comes from the LPs demanding consistent, risk-adjusted returns to pay for citizens' retirements.
Okay, we have the history, and we have decoded the underlying machine. We understand EV, EBITDA, the math of leverage, and the demands of the LPs. Now we hit the modern reality.
The game has changed.
As we said earlier, the 1980s model of just loading a company with debt hit a wall. Interest rates fluctuate wildly, credit markets occasionally freeze up, and today there is a massive amount of dry powder, uninvested LP capital chasing a limited number of good companies.
Competition is fierce.
You can't just buy a company, slap debt on it, and wait for the math to work anymore. To win today, to actually generate those returns for the pension funds, you have to actively build a fundamentally better business.
And this brings us directly to Nishant Prabhakar's core thesis in Capital in the Shadows. His career is essentially a masterclass in this exact evolution, from financial manipulation to operational heavy lifting.
Let's talk about his background because it completely recontextualizes how he views a company. He isn't a guy who spent his entire life modeling discounted cash flows in an Excel spreadsheet.
No, his foundation is technical.
He started in Bengaluru, India, with a bachelor's in computer science. And he wasn't just coasting through. He graduated with a 9.80 CGPA. He actually worked on a student satellite program for India's space efforts, and he did deep technical research spanning graph theory and complex algorithm design. He brings an engineer's systems-level precision to finance.
That technical foundation is vital. When an engineer looks at a company, they don't just see a balance sheet. They see a complex system of inputs, throughputs, and outputs. They see bottlenecks, latency, and structural inefficiencies.
It's a completely different lens.
Absolutely. After his computer science degree, she went to the Indian Institute of Management Indore, graduating in the top 5% of his class, and then built a formidable career deploying capital across some of the most respected platforms globally. We are talking about Premji Invest, his time at Flipkart, the Rohatyn Group, HSBC. He has operated across buyouts, growth equity, and early venture investments.
And the central takeaway from his writing is a complete repudiation of the old corporate raider model. He argues that modern success requires operational value creation. The PE firm can no longer act as a passive bank. It has to act as an active architect.
If we break down his framework, he categorizes this operational transformation into 5 pillars. These are the specific levers a modern PE firm must pull. But it's important to understand the friction involved in pulling them.
What's the first pillar?
The first pillar is revenue growth. This seems obvious, sell more stuff. But in a mature company, organic growth is incredibly hard. It requires the PE firm to help the company enter entirely new geographic markets, launch adjacent product lines, or restructure their pricing strategy to target premium segments.
Makes sense. What's next?
Pillar 2 is margin expansion. Because if you grow revenue by 20%, but your costs also go up by 20%, you haven't actually created any new underlying value.
True, but I hear a term like margin expansion and my eyes glaze over. It sounds like corporate jargon for firing the middle managers and making everyone else work weekends.
It often gets a bad rap, but here's how it actually functions in a modern context. It's about rigorous operational efficiency. A key tool PE firms use here is zero-based budgeting.
How does that work?
In a normal corporation, a department head looks at last year's $10 million budget, adds 5% for inflation, and asks for $10.5 million. In a zero-based environment, the budget starts at zero every single year. The department head has to meticulously justify every single dollar of that $10.5 million based on its direct return on investment.
I imagine the friction there is immense. You have legacy executives who have operated on autopilot for a decade, suddenly being interrogated on their software subscriptions and travel budgets.
The cultural clash is significant, which is why PE firms bring in specialists to handle it. They also completely redesign manufacturing workflows using lean methodologies, or they leverage their massive portfolio scale to renegotiate supplier contracts.
Like a bulk discount.
Exactly. If a PE firm owns 30 different companies, they can go to a software vendor or a raw material supplier and demand a massive bulk discount, instantly expanding the margins of all 30 companies.
Pillar 3 is capital efficiency. This goes back to our house analogy with a shoebox full of cash in the closet.
Exactly. Even highly profitable growing companies can be incredibly lazy with their capital. They might have millions of dollars of working capital trapped in excess warehouse inventory because their supply chain forecasting is terrible.
Or customers paying late.
Right. They might have lax accounting standards where they allow customers to take 90 or 120 days to pay their invoices. A modern PE firm acts like a forensic accountant. They implement predictive analytics to optimize inventory, reducing the cash trapped on warehouse shelves. They tighten up receivable collections.
Getting the cash in the door faster.
Because every single dollar freed from working capital is a dollar that can be immediately used to pay down debt or fund a new marketing campaign.
Now, Pillar 4 sounds like financial magic to me. Multiple expansion. We talked about how companies are valued at a multiple of their EBITDA. So if the market values a company at 10 times its EBITDA, the goal of this pillar is to convince the next buyer to pay 12 or 14 times EBITDA. How is that not just the 1980s financial engineering all over again? You're just convincing someone to overpay for the exact same earning.
It's not magic. It's about fundamentally altering the risk profile of the asset. The market pays a higher multiple for certainty.
What do you mean?
If a PE firm buys a messy, founder-led company with erratic cash flows, zero succession planning, and paper-based accounting, the market might only pay 8 times EBITDA because the risk of failure is high.
It's a risky bet.
Over 5 years, the PE firm installs a professional management team, digitizes the entire enterprise, diversifies the customer base so they aren't reliant on one big client, and creates a highly predictable recurring revenue model.
So the engine isn't just bigger, it's vastly more reliable.
Exactly. When they go to sell that company, a strategic buyer like a massive public corporation will look at that clean, professionalized, de-risked asset and happily pay 14 times EBITDA because the perceived risk is gone. You expanded the multiple by changing the narrative and the institutional quality of the business.
And the final pillar, number 5, is deleveraging, which we already explored. Using that newly optimized cash flow to aggressively pay down the bank debt, automatically transferring value to the equity holders.
Yeah.
But who is actually doing this work? It's not the 25-year-old Excel wizards at the PE fund, right? They don't know how to optimize a chemical supply chain.
No, they don't. And this is the defining feature of the modern operational model, the operating partner. Modern PE firms maintain a bench of seasoned industry veterans.
Like former CEOs.
Exactly. These are former Fortune 500 CEOs, global supply chain experts, digital transformation specialists, and pricing data scientists. When the firm executes a buyout, they embed these operating partners directly into the target company. They aren't just consultants writing a report. They sit on the board, they take interim executive roles, and they co-create the transformation alongside the management team.
To really see this operational philosophy pushed to its absolute limits, we need to shift our focus to a specific geography. We are going to look at India.
A fascinating market.
This is a market that Bob Barker intimately understands, having operated there extensively. And according to his frameworks, India provides the perfect high-stakes laboratory for modern private capital because you simply cannot rely on the old American playbooks.
No, you'd fail instantly.
But to understand why the India model is so unique, we have to understand the economic environment it grew out of.
You have to look at the pre-liberalization era, prior to 1991. India operated under a system commonly referred to as the license Raj. It was an era of intense, centralized bureaucratic control over the economy.
How intense.
The state literally dictated who could operate in which industries, how many units a factory was legally allowed to produce, and what technology they could import.
So if you were a brilliant Indian entrepreneur with a disruptive idea, getting funding was nearly impossible. You'd spend years just waiting for government permission to open a factory, let alone trying to secure capital. The commercial banks were mostly state-owned and deeply risk-averse. Private equity, as we understand it, simply did not exist.
It was a desert for institutional capital, but underneath that heavy bureaucratic restriction, there was a deeply ingrained, centuries-old history of trading communities, dense regional industrial clusters, and resilient family-owned businesses.
The talent was there.
The entrepreneurial DNA was dense. It was just starved of capital and oxygen. When the Indian economy finally began to liberalize and open to global markets in 1991, things began to shift. But the true inflection point, the spark that ignited the modern Indian private equity boom, happened in the year 2000.
The Warburg Pincus investment in Party Airtel.
Yes. Warburg Pincus, a massive global private equity firm, made the decision to invest roughly $292 million into an emerging Indian telecom company called Party Airtel, led by Sunil Mittal.
Which was a massive risk at the time.
At the time, committing nearly $300 million to a single Indian enterprise was viewed by many on Wall Street as an incredibly reckless, almost absurdly bold bet.
But it paid off massively.
It became one of the most successful private equity deals in global financial history. It validated, once and for all, the potential for deploying patient, long-term institutional capital in India. But more importantly for our discussion, it birthed what Prabhakar identifies as the India model of private equity.
Right, because Warburg Pincus couldn't just copy-paste the 1980s American LBO model. If you flew into Mumbai in 2000 and tried to execute a leveraged buyout, you would hit a brick wall. Why?
Two massive structural reasons. First, the Indian debt markets were not deep or liquid enough to support the kind of aggressive, multi-billion-dollar junk bond leverage that KKR was using in the U.S. The banks simply wouldn't lend you that kind of money for an acquisition.
Okay, so no cheap leverage. And the second reason?
Second, and perhaps more importantly, was the cultural reality of Indian corporate ownership. The vast majority of Indian businesses were, and still are, controlled by family promoters. These patriarchs are deeply emotionally attached to their companies. It is their legacy, their family name.
They aren't looking for a quick exit.
Right. They adamantly refuse to give up 51% majority control to a group of foreign financiers.
So if you're a global PE firm sitting on billions of dollars of LP capital, but you can't use massive debt, and the founders flat out refuse to sell you majority control, what do? You have to completely change your strategy.
You pivot entirely to growth equity. This is the defining characteristic of the India model. Instead of a buyout where you take total control and use leverage, growth equity involves taking a minority stake, maybe 20% or 30% of the company.
So you're just a partner.
You inject fresh capital directly into the business to fund explosive growth, rather than using capital to buy out the existing owners.
But if you only own 20%, you can't just fire the CEO if they miss their targets. How do you implement those 5 pillars of operational value creation if you don't actually control the boardroom?
That is the supreme challenge of the India model. It requires immense diplomacy, soft power, and a total alignment of vision. You have to secure protective minority rights in the shareholder agreements, you take a highly active seat on the board of directors, and you have to act as a deeply trusted consigliere to the family promoters.
You have to win them over.
You have to convince them that your operating partners are there to help them build a global empire, not to steal their company.
And then you take this growth equity model and you pour absolute jet fuel on it in the form of India's recent technological leap. Because India didn't just slowly modernize its banking and retail sectors over 50 years like the U.S. did. It leapfrogged traditional physical development entirely, using what is called digital public infrastructure, or DPI.
This is a crucial catalyst that Prabhakar's work highlights. Over the last decade, India built foundational, government-backed digital platforms at a population scale. You have Aadhaar, which provides instant biometric identity verification for over 1 billion people.
Which solves the identity problem.
Exactly. You have UPI, the Unified Payments Interface, which allows for instant, zero-cost digital payments between any bank and any smartphone. And now you have ONDC, an open network for digital commerce.
These aren't just convenient apps. They are foundational national infrastructure rails, like the interstate highway system, but for data and money.
Exactly. Before UPI, a startup trying to sell subscriptions had to build complex payment gateways and deal with massive friction. Now the friction is zero. These digital rails completely obliterated the traditional barriers to entry,
making it much easier to scale.
They reduced the cost of customer acquisition to almost nothing and allowed Indian startups to scale at a breakneck pace that is almost unimaginable in Western markets. For a tech-focused private equity or venture capital investor, this DPI turned the Indian market into an absolute goldmine of hypergrowth.
We can see this exact life cycle play out in real-world case studies from the sources. Let's look at Flipkart, which is a perfect example, especially since Nishant Prabhakar himself worked at Flipkart at the precise intersection of corporate strategy and private markets, helping navigate this massive scaling phase.
Flipkart illustrates the seamless handoff between venture capital and private equity in a hyper-growth emerging market. In the very early days, e-commerce in India was basically non-existent. There was no standardized logistics network, many consumers didn't have credit cards, and addresses were often highly unstandardized.
They had to rely on cash on delivery, which sounds like a logistical nightmare for an internet company. You order a laptop online, and a guy on a motorbike shows up at your house expecting you to hand him a stack of physical cash.
It was incredibly difficult. Early venture capitalists had to back the founders based purely on their vision and raw execution capability. But as Flipkart proved that the model could work, the capital requirements shifted from VC scale to PE scale.
They needed more than just seed money.
They didn't just need money for servers, they needed billions of dollars to build a massive physical footprint. Massive private equity infusions funded the creation of eCart, their proprietary logistics arm. They built massive physical sorting centers, localized delivery hubs, and a supply chain capable of handling millions of cash-on-delivery transactions securely.
They were essentially using private equity capital to build the consumer supply chain infrastructure of an entire nation from scratch.
Precisely. And all of that patient, aggressive, highly operational private capital culminated in the 2018 exit when Walmart acquired a 77% stake in Flipkart for roughly $16 billion. Wow.
It was a watershed moment. It proved definitively that private capital could build category-defining, globally competitive infrastructure platforms within the complex Indian ecosystem.
Let's pivot to a completely different sector to see how the 5 pillars work in a legacy physical business. The case study in the source text regarding the PE firm TPG investing in Manipal hospitals is fascinating. Healthcare is an entirely different beast than software.
It is vastly more complex. Manipal Hospitals was a highly respected, clinical-first, family-run regional hospital network. When TPG took a stake, they didn't just write a check and wait for the population to get sick.
They went to work.
They brought a massive playbook for operational value creation. The challenge in healthcare is that you have to balance intense, uncompromised clinical excellence and patient care with ruthless financial efficiency. You cannot cut corners on medical supplies to expand your EBITDA margin.
So how did they add value? By focusing on the structural pillars, TPG helped Manipal institutionalize its corporate governance, moving it from a family-run structure to a globally compliant corporate board. They optimized back-end procurement, consolidating the buying power of the hospitals to get better prices on MRIs and pharmaceuticals.
Leveraging that scale.
And critically, they helped Manipal execute highly complex mergers and acquisitions, identifying and absorbing other regional hospital networks to achieve massive scale. They partnered with the founders to transform a respected regional player into a dominant national powerhouse.
But again, I keep going back to the psychology happening in that boardroom. Because you have two totally alien cultures colliding. On one side of the mahogany table, you have the private equity partners. Highly quantitative, intensely data-driven, focused on a 5-year exit horizon, speaking in terms of IRR and EBITDA multiples.
The finance guys.
Right. On the other side, you have deeply emotional, intuitive Indian family patriarchs whose businesses have operated on informal trust networks and unwritten loyalties for generations. The cultural friction must be intense.
It is the defining tension of the entire India model. The PE firm is attempting to introduce rigid institutional governance, performance metrics, and zero-based budgeting into an environment that largely ran on founder intuition and family loyalty.
It could blow up so easily.
It requires immense emotional intelligence from the PE partners. If an operating partner walks in and aggressively tells a founder that their supply chain is garbage, the deal is dead.
You have to convince the founder that introducing these rigid, data-driven structures isn't an insult to their life's work. It is the only way to protect, bulletproof, and scale that legacy for their grandchildren.
When that mutual trust is achieved and the quantitative rigor of PE merges with the entrepreneurial hustle of the Indian promoter, the results are phenomenal. When that trust fails, or when a PE firm tries to force an American LBO playbook onto an Indian family business, the investments almost universally falter.
So we've traced the entire arc. We started with merchant guilds syndicating risk. We saw JP Morgan impose discipline. We saw the 1980s raiders weaponize debt. And we tracked the vital shift toward Nishant Prabhakar's philosophy of operational value creation, the 5 pillars. And we saw that philosophy tested in the complex, high-growth crucible of India.
A long journey.
Now, we have to look to the horizon. If India is the geographic frontier of private equity, what are the technological and societal frontiers? Where is the puck going in the next decade?
To understand the future of this trillion-dollar machine, we have to look to Prabhakar's broader thought leadership, specifically his thesis in his work, The Compute Shift.
What's the premise?
His core argument is that our entire foundational understanding of what computing is fundamentally changing right now.
Let's visualize this. Historically, computing was a localized tool. If you wanted water, you dug a well in your backyard. If a company wanted computing power, they bought a server, put it in a closet, and ran their own database. Then we moved to the cloud, which was like getting water delivered. But what Prabhakar is arguing is much bigger than that, right?
Much bigger, with the massive, almost incomprehensible scale and energy requirements of modern artificial intelligence, high-performance computing clusters, and emerging quantum systems. Computing is ceasing to be a tool.
What is it becoming?
It is converging into a unified, foundational, industrial-scale infrastructure.
Like the creation of the National High-Voltage Electrical Grid in the 1920s or the National Highway System, it becomes the invisible substrate that everything else runs on. But how does this massive macroeconomic shift actually change the day-to-day job of a private equity investor trying to buy a company?
It changes the very nature of how they evaluate risk, how they conduct due diligence, and how they find deals. Think about the current PE model. When a firm decides to buy a company, they enter a phase called due diligence. It is a grueling, brute force process.
The data rooms.
Yes. The PE firm deploys an army of junior associates who spend months trapped in virtual data rooms, manually verifying thousands of vendor contracts, scrubbing historical spreadsheets, and building massive, complex cash flow models.
It's an arms race of Excel wizards.
It was. But as AI integrates into the financial infrastructure, the vast majority of that quantitative heavy lifting will be completely automated. An AI model will be able to ingest and audit a company's entire 10-year financial history and every single legal contract in a matter of hours, flagging anomalies that a human associate would miss.
That's incredible.
Furthermore, AI systems are now ingesting massive amounts of alternative, unstructured data.
What kind of data?
We are talking about utilizing machine learning to analyze satellite imagery of a retail chain's parking lots to verify foot traffic independently of management's claims.
Oh, wow. Literally spying from space.
Scraping real-time global supply chain pricing to predict margin compression. Analyzing employee sentiment on public forums to gauge corporate culture before a buyout. AI will identify predictive market signals before a target company even realizes it needs to raise capital.
So the competitive edge of a PE firm completely shifts. For the last 40 years, the winner was often the firm with the biggest army of analysts who could crunch the numbers the fastest and build the most complex debt models. If the AI perfectly automates the math, the edge shifts entirely to human judgment.
That's exactly it.
The winner is the firm with the most creative vision for what a company can become and the empathy to actually convince the founders to execute that vision.
Exactly. The commodity is no longer the data. The commodity is the calculation. The premium is on synthesis and execution. And the type of companies they are applying this judgment to is also shifting radically. This brings us to the rise of intangible assets.
This is fascinating. Historically, PE firms bought highly tangible things. JP Morgan bought steel rails. The 80s raiders bought tobacco factories and retail real estate. If the company went bankrupt, you could at least sell the land and the machinery to recoup your losses.
But today, the most valuable assets in the global economy are entirely intangible. Think about the most dominant companies today. Their value isn't in their office buildings. It is in proprietary data lakes. Deeply entrenched network effects, intellectual property, algorithms, and fiercely loyal digital brand communities.
You can't put a network effect on a traditional balance sheet. If a social media platform goes bankrupt, you can't liquidate their user base to pay back the bank.
You can't. And that means traditional valuation models, like the discounted cash flow models that rely heavily on valuing physical collateral and predictable historical margins, are breaking down.
They just don't apply anymore.
They have to be entirely rewritten to understand the nonlinear growth curves. The winner takes most economics and the rapid obsolescence risk of the modern digital platform economy. Valuing a sauce company requires a completely different mathematical language than valuing a paper mill.
There is one more major structural shift we have to cover. It is a term that often gets dismissed in the media as a political buzzword or a marketing gimmick. But the sources we are looking at are absolutely clear that it is now a fundamental, non-negotiable pillar of the global private equity machine. ESG. environmental, social, and governance criteria.
It is critical to separate the media narrative from the financial reality here. In the context of institutional private equity, ESG is absolutely not a philanthropic buzzword, and the push for it isn't coming from activists. It is coming directly from the top of the capital stack, the limited partners.
The LPs we talked about earlier.
The massive public pension funds and sovereign wealth funds are demanding strict ESG compliance.
Because they view it through the lens of liability matching and long-term risk.
Yeah.
Let's be clear, a pension fund isn't demanding a green supply chain because they want to feel good. They're demanding it because their investment horizon is 30 years.
Precisely. They recognize that ESG is a core, highly quantifiable risk management tool. Let's look at it practically. Imagine a PE firm is looking to acquire one of two chemical manufacturing plants.
Okay.
Plant A is highly profitable today, but it relies on cheap, high-polluting energy sources and dumps its waste legally but unsustainably. Plant B has lower margins today, but it has invested heavily in circular water systems and renewable energy inputs.
The pension fund looks at Plan A and sees massive, unpriced regulatory risk. They know that in 5 years, new carbon taxes or environmental regulations could turn that profitable plant into a stranded asset, essentially worthless.
Exactly. Environmental criteria mitigate regulatory and operational risk. Social criteria ensuring fair labor practices and supply chain transparency mitigate massive reputational risk. Governance criteria, having a transparent, diverse, non-insular board of directors, mitigates the risk of corporate fraud and blind spots.
So a company with highly integrated ESG practices is fundamentally a more resilient, de-risked asset. And going back to Pillar 4 of our value creation model, multiple expansion, because it is a low-risk asset, a future buyer will pay a significantly higher multiple for it. ESG integration directly drives financial returns at the exit.
It is the ultimate alignment of risk mitigation and value creation. And this realization brings us full circle to Nishant Prabhakar's ultimate philosophy. It is the core unifying theme that runs through all of his writings, his frameworks, and his entire $2 billion transaction history.
Which is?
He fundamentally believes that investing is not merely about passively deploying capital to capture a yield. It is about actively shaping outcomes.
Capital is directional.
It is deeply directional, and it is highly consequential. The private equity industry manages trillions of dollars. Where they choose to deploy that capital, and the operational rigor they enforce once it is deployed, dictates which frontier technologies get commercialized, which medical supply chains become resilient, how quickly emerging economies like India integrate into the global digital stage, and whether our industrial infrastructure transitions to a sustainable model.
It's massive.
The mechanics of private equity are inextricably tied to the trajectory of societal progress.
Okay, let's take a breath and connect the dots of this incredible journey. We started on the precarious wooden docks of 15th century Venice, watching merchant syndicates pool their risk to fund impossible spice voyages. We watched J.P. Morgan impose ruthless operational discipline on the chaotic American railroads.
We saw the 1980s corporate raiders weaponize high-yield debt to shock the corporate establishment.
Right. Then, guided by Nishant Prabhakar's deep expertise, we finally decoded the mathematical engine of the industry understanding enterprise value, the necessity of EBITDA, and the mathematical alchemy of leverage. We tracked the vital evolutionary shift away from pure financial manipulation toward the 5 pillars of operational value creation, where PE firms act as the actual architects of a business.
And we saw that philosophy tested in India.
Exactly. Adapted and proven in the complex, high-growth crucible of India, navigating the intense cultural friction between deeply rooted family legacies and rigorous institutional governance. And finally, we look to the horizon. The compute shift, turning AI into utility infrastructure, the dominance of intangible assets, and ESG acting as the ultimate LP-driven risk mitigator.
It is a remarkable continuous evolution. Private equity has grown from a highly niche, almost secretive financial craft into the foundational hidden scaffolding of the entire global economy.
And that is the ultimate so what for
Yeah.
you, the listener. You now possess the decoder ring for understanding the business world around you.
The curtain is pulled back.
The next time you open a news app and read a headline about a multi-billion-dollar corporate buyout, a logistics startup achieving unicorn status, or a major consolidation in the healthcare space, you won't just see the surface-level PR jargon. You will actually see the massive gears turning beneath the surface. You will understand the operational levers of value creation being pulled, the harsh discipline enforced by the debt structure, and the massive, unrelenting long-term expectations of the pension funds demanding results to fund retirements. You are no longer just looking at a transaction. You're seeing the actual machinery that shapes our physical and digital reality.
When you understand the flow and the mechanics of capital, you understand exactly how the future is being built.
Which leaves us with one final, lingering thought to mull over. We talk about how artificial intelligence is continuing its relentless advance, getting closer and closer to perfectly automating the quantitative mathematical art of valuing companies and identifying market inefficiencies. If the math becomes a perfect automated commodity, what happens to the humans?
A great question.
Will the future of private equity rely less on the spreadsheet genius of the investor and entirely on the messy, deeply human empathy required to sit across a mahogany table from a founder, look them in the eye, and lead an entire workforce through the endless, grueling, deeply emotional cycles of corporate transformation? Because an algorithm can calculate a perfect EBITDA multiple in a millisecond, but it cannot sit in a room and tell a CEO how to fire their best friend to save the business. We'll leave you to think about that. Thanks for taking the deep dive with us.